Hello everyone. I hope all your studies are going really well. Today we are going to discuss the direct tax amendments applicable for the May 2025, September 2025 and the Jan 2026 exams. If you have any other amendments coming in between, I will make a separate video on that when the applicable exam nears. But as of now, whatever we are discussing today stands good for the May exams, the September as well as the next Jan exams. So watch this video very carefully. Pay a lot of attention to whatever points I'm going to discuss now, because like we all know, whatever amendments that take place in tax becomes one of the focus areas of the institute to ask you questions in your exam. Just like the past trend has indicated, 35% plus marks are very easily allocated to areas of amendment, especially when radical changes happen, like we'll see this time for capital gains. When these sort of areas undergo a very major, very significant change, it becomes a focus area of the institute for a minimum of 3 to 4 attempts very easily. So pay due attention to this thing. We'll be discussing all other amendments relevant to your exams as well. And let's start with our subject now. Okay. The first one starts with the slab rates. Of course, the slab rates in the new regime have undergone a change. See, the slab rates under the old regime remains the same for resident individual HUF below 60 years, for resident senior citizen 60 or above up to and below 80 years, or a super senior citizen 80 years and above. Whatever slab rates you've studied under the old regime remain the same. The slab rates under the new regime have undergone a change. We'll see them here. Of course, we know under the new regime, the age or residential status of the assessee does not change the rate of tax. The slab rates are now in this way. From 0 to 3 lakh rupees, the tax is nil. So your basic exemption limit under the new regime, or under the default regime as it can be referred to now, or under section 115 BAC, would be a sum of rupees 3 lakhs. Above rupees 3 lakhs up to 7 lakhs. Pay attention here. Up to 7 lakhs has become 5%. 7 to 10 is your next slab at 10%. 10 to 12, only a 2 lakh rupee shift. 10 to 12 is going to be taxed at 15%. 12 to 15 at 20%, and above 15 at 30%. These are your slab rates. The respective amount which will help you, which you have to memorize, which will help you in your exam to calculate the tax as per slab rate in a quicker way, would be of course up to 3 lakhs is rupees 0, that's nil. 3 to 7, 4 lakh rupees into 5% is 20,000. The next 3 lakh rupees into 10%, 30,000 plus 20,000 would give you 50,000. This is a cumulative number. 10 to 12 lakh rupees is 2 lakh rupees into 15%, being a further 30,000. So 50 plus 30 giving you 80. 12 to 15, 3 lakh rupees into 20% is 60,000, that giving you 1 lakh 40. There is no maximum limit above 15 lakh. So say you have an income of 20 lakh under the new regime and you're paying tax under 115 BAC. So you would get 1 lakh 40,000 plus 30% of 5 lakh rupees. That would be 1 lakh 40 and 1 lakh 50, 2 lakh 90,000. Of course, subject to your HEC and rounding off, etc. So these are your new slab rates applicable for the new regime only. The slab rates have undergone a change. Please make sure to study these properly. The special rates of tax as applicable are still going to hold good here. We'll be discussing some of these separately with regard to the capital gains amendments. The second amendment that has happened is with regard to deemed dividend or dividend. Section 2 to sub 2 clause 22, which defines dividend, now has another subclause F. Okay, so any buyback of securities that takes place on or after 1st of October 2024 will be taxed in the new manner, in which the gross amount of the buyback will be treated as dividend, deemed dividend in the hands of the shareholder. It will go into income from other sources and be taxed in that manner. However, if the buyback is taking place up to 30th of September 2024, which is before 1st of October 2024, it will be taxed in the normal manner. Okay, this is the first point that you have to know. Now, if the buyback happens on or after 1st October 2024, so what happens to the cost of the shares? This is looking unfair to the assessee. No, it is not. What happens to the cost of the share is the amount of the cost incurred by the assessee for the shares will be treated as a capital loss, short-term or long-term capital loss. If the assessee has any capital gains income, the assessee can set it off against that if set off is being allowed. If not, he can carry it forward for 8 assessment years and then set it off against any applicable capital gains. Okay. With regard to the income, the gross amount which the assessee would receive on account of the buyback will become his dividend income and income from other sources. From this sentence says no deduction would be allowed from such deemed dividend under Section 57. What is the deduction allowed from dividend under Section 57? What deduction is allowed? Just one. Interest. Whatever funds are invested by the assessee to earn dividend, if the assessee is paying interest on such sums, then that interest is allowed as deduction. How much? To the extent of 20% of the amount of dividend income includable in his total income. Okay, that much deduction would be allowed to him. But in the case of buyback of shares, no such deduction will be allowed. Whatever is the gross amount the assessee is receiving on account of the buyback will become dividend and taxed as income from other sources. These provisions are applicable for any buyback that takes place on or after the 1st of October 2024. That was a second amendment. The third amendment now, we are moving to the head of salaries. Salaries has two amendments that have taken place. The first one is the standard deduction under the new regime. See, please pay attention when I tell you certain amendments have taken place only under the new regime, certain amendments have taken place under both regimes. This is going to be very relevant. The slab rates which have changed, this is only and only in the new regime, the default regime, the Section 115 BAC regime. Okay. The amendment to Section 2, Clause 22, which I just told you about, dividend, this is applicable to both regimes. The next amendment that I'm telling you about, salaries, this is applicable only to the new regime. When you compute income under the head salaries, until now you would have given a standard deduction of rupees 50,000 under both the regimes, not anymore. Now, you will, under the old regime, continue to give a standard deduction of 50,000 rupees only, but under the new regime, under the default regime, the standard deduction has been enhanced to rupees 75,000. This would be your deduction under the new regime. This is the only one amendment here. The second amendment is with regard to valuation of the accommodation. Valuation of RFA provided by the employer of the SSE. If you remember, this is a perquisite provided to the employee. The valuation is prescribed in Rule 3.1. See, there is no change here. If the employer is the government and accommodation is provided to the employee, the license fee determined by the government will be the value of perquisite minus rent actually paid by the employee. The sum actually recovered from the employee with regard to the perquisite is not going to be treated as a perquisite, of course. Point B is where you have a change. C has not changed. D has not changed. This point B, accommodation provided by any other employer if owned by the employer. By any other employer, we mean not government, not the government. So if any other employer is providing accommodation to the employee, and if that accommodation is owned by the employer, it's owned by the employer, then the value of the perquisite would depend on the population of the city. If the city has a population of more than, above 40 lakh as per 2011 census, 10% of salary in respect of the period would be the value of perquisite minus the rent recovered. Cities with population of above 15 lakh rupees up to 40 lakh, 7.5% of the salary would be the value of the perquisite. And the residual category, the other cities, means population of up to rupees 15 lakh, correct? Up to rupees 15 lakh. 5% of the salary for the relevant period would be considered as value of the perquisite. There is no point in us going back and discussing what was the old limit, the population was different or the percentage was different or what amendment has happened. If you remember it, very good. Now you hit the delete button. Remember these values applicable to your exam and stick with them. Okay, 10%, 7.5%, and 5%, 40 lakh, 15 lakh, and residual. That is it. The other two categories are same. I have included it here for the purpose of completion. So the entire concept of valuation of rent-free accommodation is there in this one place. It's only for the purpose of completion here. Which is provided by any other employer, taken on rent by the employer, then lower of lease rental or 10% of salary. No constraint with regard to the population of the city here, minus rent recovered. For all cases, if it is furnished, then 10% per annum of the value of the furniture would be the value of the perquisite. And if accommodation is provided in a hotel, irrespective of the employer, 24% of the salary for that particular period. Exception is here, except if it is provided for up to 15 days on transfer from one place to another. Okay. Next, we move to PGBP. We have about three or four amendments to address in PGBP. This first one tells you that the renting out, letting out of residential house property will always and always stay under income from house property only. So now, even if an assessee is engaged in the business of letting out of residential house properties, the income from such house property will be taxable under the head income from house property. Fine. If an assessee is engaged in the business of letting out of commercial properties, then the income from such property can be taxed under the head PGBP. It has to be condition 1, a business of letting out, and 2, commercial properties. Only in this case will the income from these properties be taxed under the head profits and gains of business or profession. In another case, if the property is a residential house property, it will be taxable under the head income from house property only. That is what this amendment is saying. Then you have an amendment to contribution of the employer to the NPS account, the National Pension Scheme account of the SSE of the employee. This limit is now 14% of the salary. Once again, let's not go into discussing how much it was before. Certain cases 10, 14, you'll study it anyway in ATCCD, but let's focus only on what are relevant provisions for this, for your upcoming exams are. So the deduction allowed to the employer for making a contribution to the NPS account of the employee would now be restricted to 14% of the salary of the employee. This limit has been enhanced. Disallowance of settlement amounts. So what happens is, if in case you violate any provisions of certain laws, you contravene provisions of certain laws, if it is not a very serious offense. Now, when I say not a very serious offense, this is not a legal term. Okay, this I'm making a reference to this not a very serious offense just for the purpose of our understanding, because we do not have to go into what that very serious is or is not. Okay, so if it is not a very serious contravention, something which can be remedied by monetary compensation, a lot of times what might happen is that settlement proceedings can be opted for by the SSE, where prosecution does not happen and where detailed legal proceedings would not happen. The SSE would pay certain amount to make good whatever contravention has taken place, and then he would be left free. So, such settlement amount paid by the SSE, settlement amount related to any infraction of law, so basically any violation of law, will not be allowed as business expense. We already know that Section 37 disallows any expense incurred by the SSE for any purpose that is unlawful or for violation of any act, or even, for example, any penalties paid, because penalties paid are for violation of laws. So such expenses were always disallowed. But this explanation that is there, it further clarifies that if any settlement amount is being paid by the SSE, settlement amount is being paid only because something is there to settle. Something is there to settle because you have violated a certain law. So, if you are paying any settlement amount to make good this violation, this contravention, that will not be allowed as a business expenditure. That is what this provision is saying. Very, 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 very important point here. The next one, which we are discussing, maximum remuneration allowable in case of working partners of a firm, section 40B. So, with regard to partnership firms, if you remember, section 40B makes two very specific points. First of all, deduction with regard to interest on the capital of the partner. Interest on the capital is allowable only to the extent prescribed, authorized by the partnership deed. Up to 12% per annum simple interest is allowed. That position remains as it is. Salary under section 40B was allowable, first of all, only to working partners of a firm. Secondly, only in accordance with the terms of the partnership deed. Thirdly, certain limits were provided that either the remuneration the remuneration has to be within either the limit provided here or the one prescribed in the partnership deed, whichever would give you a lower amount, of course, right? Only to the extent allowable by the partnership deed or by the act. So now in the act, these limits were different before. These limits were different. I am very certainly expecting a question on this particular concept either in the May exam, and if it gets delayed, then in the September exam. So please make sure to remember and revise this point and be very clear about it. On the first 6 lakh rupees of the book profit, or in case of a loss. Which loss? Loss as per book profit. What is book profit? Book profit is income computed in accordance with the provisions of the Income Tax Act, where depreciation, etc., all of these items would be allowed as deduction only as prescribed in the Income Tax Act. All amounts would be deducted except this particular remuneration. That is what is book profit. So, first 6 lakh rupees of that book profit, or in case of a loss, the remuneration allowed as deduction would be rupees 3 lakhs or 90% of the book profits, whichever is more. Whichever is more in the sense. Now, if you have a book profit of 4 lakh rupees, then 90% of this would imply 3 lakh 60,000 or 3 lakh. Whichever is more would be 3 lakh 60,000. If you have a book profit of 3 lakh rupees, then 90% of this would mean 2 lakh 70,000 or 3 lakh, whichever is more. So that would be 3 lakh rupees here. And on the balance of the book profit, 60% of the book profit. Okay, it's this first one that has undergone a change. So please learn that very carefully. That's going to be very important. Transfer of capital asset under a gift or a will. This earlier was not restricted to certain SSEs. Any SSE who transferred an asset under a gift or will, such transfer was excluded from the definition of transfer. It was not considered a transfer at all. No capital gains would arise on this transaction. However, this section has undergone an amendment now, which states that only if the transfer under a gift or irrevocable trust or will, these 3 points, is made by an individual or HUF, only an individual or HUF, then it is not going to be regarded as transfer. No capital gains tax would arise on this. For all other SSEs, capital gains tax will arise on this particular transaction. We have a lot of amendments in capital gains. We will be looking at this at the end. We'll look at all the other smaller points first, and then we'll address capital gains as one single focused chunk. Okay. 56 to 7b. This, if you remember, there was a section which said that if you have a closely held company and the closely held company makes an issue of shares, fresh issue of shares, then this company would have to first get the fair value of its shares determined. The fair value was determined, say, rupees 120. This company issued shares at a premium at the rate, the fair value is rupees 120 per share of rupees 10 face value. Shares at rupees 140, and the face value is 10 rupees. So if shares are being issued of rupees 10 face value at rupees 140, you know that the premium is rupees 130. However, the fair value of these shares is only rupees 120. So how much in excess is the company charging? 20 rupees. How did we get this? 120, the fair value, or say 140, the issue price, minus 120, the fair value, that is the excess charged by the company. This rupees 20 used to be treated as income of the company. Okay, this 20 rupees used to be treated as the company's income. However, with regard to omission of section 5627B, this provision is no longer applicable. This provision no longer holds good. This 20 rupees will not be the income of the company anymore. So if the fair value is rupees 120 and the closely held company issue shares at 140, 180, 200, doesn't matter. The excess amount over and above the fair value will not not be treated as the income of the company anymore. It's very important. I'm expecting a theory question or an MCQ on this thing. Okay, so this is very important, that in 56 to 7B is no longer applicable from this assessment year. This assessment year means assessment year 25-26. Okay, increase in standard deduction from family pension. See, let me just tell you a few things regarding the regime once more. See, this change for standard deduction under salaries, this was only for the new regime. The change in valuation of rent free accommodation, this is for both regimes. So both regimes. Amendment to section 28, this is for both regimes. This one is also for both regimes. Increase in deduction pertaining to NPS. Disallowance of amount for settlement provision. Of course, it's a disallowance, it's for both regimes. Maximum remuneration to partners of a firm, both regimes. Transfer of capital asset is for both regimes. Omission of section 56 to 7B, this is also for both the regimes. But the next one that we are studying, increasing the standard deduction from family pension, this is only for the new regime. Okay, section 57 allows a deduction from family pension. See, family pension means pension received by family of the deceased ex-employee, the former employee who worked, in whose for whose work pension is being earned. When such pension is earned by not the assessee because he has deceased, he's been deceased, by the family of such assessee, then that is called family pension. From this family pension, a standard deduction of one third the family pension. One third the family pension is allowed. The maximum monetary limit of this used to be 15,000 rupees for both regimes. However, after this amendment, this limit has been increased to 15,000 rupees. In the old regime remains as it is. It has been increased to 25,000 rupees under the new regime. Only under the new regime, the default regime, this increment has happened. Okay, 25,000 rupees of standard deduction would be available from family pension. One third of the family pension or rupees 25,000, whichever is lower. Under new regime, one third of 15,000, whichever is lower under the old regime. There is a difference in regimes here, so both provisions have to be known by you. The next amendment is more of a, a wording change only. It's for section 80G, but now it's important for us nonetheless since it's an amendment. So 80G, if you know, has a deduction available if you make a contribution from your from income. So basically, from gross total income, you have four different categories where you have 100% of deduction allowed without a qualifying limit, 50% deduction without qualifying limit, and 100% of 50% subject to qualifying limit. The qualifying limit is 10% of your adjusted total income. Okay, 10% of the adjusted total income for section 80G. In that, one point was there of National Sports Development Fund. What happened is, in the Income Tax Act, this was called National Sports Fund, and when the government set up the fund, they called it National Sports Development Fund. So the only amendment in the the Tax Act happened to incorporate this appropriate name of the fund, National Sports Development Fund. That is only the name change. Only to incorporate the right name of the fund is the amendment. But now, since it's an amendment, please remember that for a contribution to National Sports Development Fund, the deduction available to the assessee is 100% of sum contributed without any qualifying limit. If you remember the four categories under section 80G, this would be the first one, the A category, where you have 100% deduction without a limit. Okay. Quoting of Aadhaar number, again, this is one of your theory points. So, in quoting of Aadhaar number, basically the old provision, if in case the assessee did not have an Aadhaar number, the assessee was allowed to quote an enrollment ID. When the assessee applies for an Aadhaar card, an Aadhaar number, he is given an enrollment ID. He was allowed to quote this ID instead of the Aadhaar number with regard to for linking with his PAN or to obtain a new PAN card. However, now With effect from October 1, 2024, such quoting of enrollment ID is no longer allowed. You have to mandatorily quote only your Aadhaar number to obtain a new PAN card. Secondly, if in the past you had quoted your enrollment ID with regard to your PAN, now you have to quote your Aadhaar number, get your Aadhaar number itself linked to the PAN card. That is what this amendment says. That is all. It's a fairly simple one. It's a theory provision. You can go through this. TDS on salary, there is only one change, that TCS will also be taken into account now. What happened with TDS is that the employer was responsible to compute the tax, the total income of the SSE, the tax on total income of the SSE, and deduct TDS at the average rate of tax under section 192. So, if you remember all the TDS sections, in all of the sections you have a rate specified. 192 says average rate of tax. It is for the employer to compute the income, the tax thereon, and find the average rate of tax and deduct TDS at such rate. What happened to the employee, in case the employee was also getting covered under some TCS provisions, was that he's paying TDS out of his income. His employer is deducting TDS out of his income at his average rate. Further additional amount is going out as TCS also. But Section 192 never told the employer to give credit for TCS deducted. The employer had to deduct tax at the average rate of tax itself, otherwise it would be a non-compliance for him. So this amendment has been brought in for benefit of the employee, to give some bit of relaxation to the employee, so that excessive amount of tax is not collected from him before the before his assessment year, during his previous year. So here, while the employer computes the amount of tax to be deducted from the salary, he will also take into account any TCS claims available to the employee. This is with effect from 1st of October 2024. See, October 1, 2024. With regard to interest on securities, TDS under section 193, certain bonds were notified as no TDS would be deducted from them. However, now TDS will be deducted from them once such security is floating rate savings bonds. Please remember this item. So, if you have floating rate savings bonds and the income you earn from this bond, the interest exceeds rupees 10,000 during the financial year. Exceeds means at 10,000 no TDS. If the income exceeds 10,000 rupees, TDS under section 193 would become applicable and would be deducted with effect from October 1, 2024 again. TDS on buyback payments. See, buyback payments TDS would only be applicable until when? See, from 1st of October 2024, it has become taxable in the hands of the shareholder as dividend income. So, no more deduction of tax at source would be required on such income. Now, after the amendment, money received will be treated as deemed dividend, taxable under income from other sources. No deduction would be allowed. Okay. 194C, a very simple change has happened in 194C. So, if you remember when you would have studied 194C, 194J, you would have a lot of cases where the SSCs had a confusion between 194C, 194J. And you have a number of case laws also on this, like the airport authorities one, where the jet lands and there's some fee being paid to the airport, or for example passenger service fee being collected from the passengers and remitted to the airport authorities. How TDS works on this, or cold storage, one more example for you there on all of these items. So 194C versus 194J is in general a slight gray area. This is one effort to reduce that confusion between 194C and 194J. The amendment which you see here is 194J has specifically now been excluded from 194C. What this says is, for work for the purpose of 194C will not include any situation to which 194J is applicable. See, work for the purpose of TDS under section 194C will not include any transaction or any scenario, any circumstance which is getting covered under section 194J. Okay, some SSCs prefer to get the TDS deducted under section 194C because it has a lower rate. 194J in general has a higher rate. In general, rates are different. In general, it has a higher rate. 194IA has an amendment, TDS on sale of immovable property. So, if an immovable property is being sold by a resident and the stamp duty value or the consideration for transfer is 50 lakh or more. See, TDS under 194 IA is applicable if either one, the stamp duty value of the property or the sale consideration, either one, no 10% criteria here. If either one is 50 lakh or more, so at 50 lakh also TDS is applicable, then amount of tax to be deducted by the buyer of the property is 1% of whichever is the higher amount, the stamp duty value or the purchase consideration. Whichever is higher than 1% of that will become the TDS. The amendment that has happened is to say that this limit of 50 lakh or more is to be reckoned per property, not per seller. So if you have a property that is being sold that is worth 60 lakh rupees, and this one has joint owners, Mr. A and Mr. B, and say they are equal owners, 50% each, then the consideration which you would pay would be 30 lakh rupees to each of them. Now the question arises whether to deduct TDS under 194 IA or not, because you are paying only 30 lakh rupees to each of them. With this amendment, the position of the law is extremely clear now that to decide whether TDS under section 194 IA is applicable or not, you will only see this number, this 60 lakh rupees will help you decide. It's to be reckoned with regard to the consideration of the property as a whole and not with regard to each joint owner's share in the property or in the sale consideration. So in our example which we have taken, TDS under section 194 IA would be applicable. Okay, that is what the amendment says. The time limit to file correction statement for TDS TCS. See, there was no such time limit previously to file a correction statement. There was a time limit to file the statement itself, but no time limit to file the correction statement. Now this has been introduced. The correction statement has to be filed within a period of 6 years from the end of the financial year, in which the the quarterly statement were required to be delivered. In which the statement was required to be delivered. So it is 6 years from the end of the financial year. Maximum a theory question, but I don't see this as one of the focus areas right now. TCS under section 261F. See, the only amendment that has taken place is 1F, if you remember, was only for motor vehicles. It was for cars, motor vehicles. If sold for a value exceeding rupees 10 lakhs, motor vehicles, exceeding rupees 10 lakhs, then at the time of receipt, TCS equal to 1% of the sale consideration had to be collected by the seller. Okay, if you remember, this is for retail sale of motor vehicles. Now, the scope of 261F has been expanded, which says that as may be notified, if there are any other luxury goods as notified by the government, then those will also fall under the ambit of 261F. The value exceeds rupees 10 lakhs. Luckily for you people, you don't have to study any list of such goods, because of course this amendment itself is not applicable to you if it's going to be notified with effect from Jan 1 2025. For you, what is applicable is this, that other than motor vehicles, things can be included in 261F scope. All you have to remember with regard to this amendment is the scope of the section, that 261F is no longer restricted to only motor vehicles. It also includes other things if notified by the government. That's it. You don't have to know what those other things are. If notified by ICI for future exams, could be September 25 or Jan 26 or thereafter, then we'll see that separately. For May 2025, no such list has to be known. Okay. Finally, amendment to TDS rates. After this, we'll move to capital gains. Amendment to TDS rates is very, 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 very important. If you see your total income problems, in a lot of problems, you will be given certain incomes at the gross amount and certain incomes at the net amount. When given at the net amount, the institute is expecting you to arrive at the gross amount, tax it accordingly, then give the TDS credit, and then find the tax payable. In those cases, these TDS rates are going to be extremely important to you, and it's very, very simple. Whatever was 5% for these sections has become 2%. These were all 5% sections. Payment in respect of life insurance policy. What payment is this? Maturity proceeds. Payment in respect of life insurance policy when not exempt. When not exempt. 194G is commission on lottery tickets. H is commission on brokerage. Okay, both these commission sections are here. 5% was the old rate. From 1st October 24, it is 2%. So you have to remember both the rates. Luckily for you, you have to remember both the rates. For from the next assessment year onwards, which is after Jan 2026, you'll probably have to remember just one rate. For now, you will have to know both because up to September 30, 24, it's 5%. On and after 1st October 24, it's 2%. Both rates have to be known. 194 IB, payment of rent by individual HUF, 2% with effect from 1st October 24, and 194M. If you see, 194M basically covers those cases where individuals have to deduct TDS when they don't get covered under other sections 194C, 194J, etc. So the TDS rate there used to be 5%, now it has become 2%. That is all is the relaxation that has happened in the TDS rates. Very important for you to know. Okay, let us look at capital gains now. See, capital gains has undergone a revamping. Whatever you would have had as a premise of capital gains, as an understanding of capital gains, and frankly speaking, capital gains was one of the easier chapters in income tax. Of course, after income from house property, if there was something which everyone considered to be a little more doable, a little more easy compared to say things like PGPP or total income problems, it used to be capital gains. But capital gains has undergone a full revamp. Why am I calling it a full revamp? Why am I not saying it's just an amendment, small points, this and that? You'll see when we solve questions on this thing, you'll understand it. For now, we are only looking at the amendments, so it might seem a little bit small to you, but eventually you would understand why I'm saying it's a revamp. So please approach capital gains with a fresh mind. That's why even in the amendment notes, you're seeing it as a whole separate section in itself. Also, please note you will get these amendment notes as a PDF copy. All right, you'll find a link in the description. Please take a copy of these notes and study these thoroughly. Okay, so capital gains. First of all, classification of an asset. Classification of a capital asset as long term or short term earlier had different buckets. Now you have only two: held for 12 months or more versus held for 24 months or more. That is it. You have only two categories now. If these four items are held for 12 months, are held for more than 12 months, they become long term capital assets. Securities which are listed on a recognized stock exchange, these are talking only about listed securities, any listed security. Units of equity oriented fund, units of UTI, and zero coupon bonds, these need not be listed ones. Units of EOF, UTI, and zero coupon bonds, if held for a period exceeding 12 months, will become long term capital assets. Only these four fall under the more than 12 months category. All other capital assets would be long term if held for a period of more than 24 months. So, painting would come here, gold would come here, any precious metals, diamonds, precious stones, semi precious stones would come here, land and building would come here, all other items would come here. Okay, please remember this one point separately. Slump sale. When an undertaking is being sold as an undertaking, as a single unit, and the transaction gets covered in slump sale, you have different criteria, right? Individual value should not be assigned except for stamp duty purposes, etc. Should be sold as one single undertaking. It should have the assets and liabilities all being transferred. All of these different things. Revaluation will not be considered. So for slump sale, when an undertaking is being sold, the time frame remains 36 months. That is because this 50B period of 36 months was not linked to any other definition of long-term capital asset, short-term capital asset. 50B itself had 36 months written, that continues to have 36 months written. It's very important to note this point. For slump sale, please don't apply the same 1224. For slump sale, only 36 is applicable because section 50B specifically says 36 months. For all other assets, you will put it only in one of these two buckets, 12 months or 24 months. Indexation benefit. As one blanket statement, indexation benefit is no longer available. Okay, but in some ways, indexation benefit is still available. That we are going to have a look at now. If you understand section 112, the other items are very easy. 112A and 111A are very simple. It's nothing very complicated in them. Please pay attention to 112, understand this properly. For items which get covered under section 112. What items get covered under section 112, sir? Just let us understand two items. One, land and building. The other one, assume you have listed shares on which STT was not paid on acquisition. So it can't get covered under 112A. See, 112A has a condition. Listed equity shares if STT has been paid on acquisition and transfer of such shares. So assume you have some listed equity shares on which STT has not been paid on either one of these. So it can't go to 112A, so it is going to 112. Okay. And second item is land and building. Fine. These are the two items I want you to consider for 112. Now, if the transfer took place before 23rd July 2024, see, there are a lot of dates which you have to remember in tax. Okay, a lot of dates are there. For example, house property, 1st April 1999, or for example, in salaries with regard to LTA, 1st of October 1998, or for example, in all these other areas with regard to insurance, your insurance policy, ATC deduction or 1010D exemption, 2003, 1 for 2003, 1 for 2012, 1 for 2013, 1 for 2023, various items, or forfeiture of amount for income from other sources versus capital gains, or rates of depreciation, could be for windmill, could be for other items. For a lot of things, you have dates to remember. This is one more date which you mandatorily have to remember: 23rd of July 2024. If you have transfer of of a capital asset, of a long term capital asset taking place before 23rd July 2024, these provisions will be applicable. So, if that capital asset is unlisted securities or shares of a closely held company, for normal SSEs, 20% with indexation benefit will be the rate of tax. Non-residents, a non-resident non-corporate or a foreign company, 10% would be the rate of tax, but no benefit of indexation and foreign currency fluctuation. If it is listed securities or zero coupon bond, then 10% without indexation, 20% with indexation, whichever is beneficial to the SSE could choose. Other assets, 20% with indexation, only one item. This is how Section 112 was taxing long-term capital assets before, if the transfer took place before 23rd July 24. But if the transfer takes place on 23rd July 2024 or after 23rd July 2024, on or after 23rd July 2024, then two things. First, if that transfer is of land or building or both, point number one, it has to be land or building or both. Point number two, it has to be acquired before 23rd July 2024. Before 23rd July 2024. Not on or after, before. Point three, transfer has to be made by a resident individual or resident HUF. By a resident individual or resident HUF. Then the rate of tax would be 12.5% without indexation or 20% with indexation, whichever is more beneficial. See, what happened is the government suddenly removed indexation benefit on blanket long-term capital gains items, long-term capital assets. Land and building got included in that. The middle class, the normal typical middle class Indian got hit by it very badly when the government said no indexation. Even if the government lowered the rate of tax from 20% to 12.5%. So even if the tax rate was reduced from 20% to 12.5%, if the benefit of indexation was taken away, what happened with most people is the reverse worked their gains and said, in order to benefit from this new lower tax rate by foregoing indexation, my property needs to appreciate by at least some 11-12% per annum, but it's not appreciating by that much. The best case scenario in some of the fastest growing cities turned out to be about 9%, 8%, 6%, even 10% in some cases, but never, almost never enough to benefit from the lower or the reduced rate of tax. Hence, the government had to bring in this particular benefit, this optional benefit to resident individuals and HUF, saying that no problem, you pay tax as per the older provisions itself. You pay at 20% with indexation or 12.5% without indexation, whichever is more beneficial to you, subject to these conditions. This is only for land and building. For all other assets, any other asset, be it land or building acquired on or after 23rd July 2024, or any other asset not taxable under 112A, the rate of tax will be 12.5% without indexation Doesn't matter when the asset was acquired, who is the transferee of the asset, who's the transferor of the asset. None of these things would matter. The rate of tax will remain 12.5% without any indexation benefit. Let us see triple one A now. Section triple one A is for STCG of certain items. See, STCG on transfer of listed equity shares, units of equity oriented fund, and units of business trust. On these three items, if the transfer is before 23rd July 2024, the rate of tax is 15%. On or after the set date, it's going to be 20%. The only amendment is in the rate of tax, nothing else. These items are same. This condition is same, that if the transfer takes place on recognized stock exchange and IFSC, money is being received in foreign currency, and even if so that the rate of tax would be 15 or 20%, even if STT is not paid on the transfer, because here you have the condition mentioned. Triple one A only change in the rates of tax. STCG on all other items remains the same. It will be on normal slab rates, normal rates of tax. No changes there. 112A. See, this limit of deduction or exemption under 112A was different earlier. It has been modified to 1.25 lakhs from this particular assessment year, from 25-26. This is one key amendment in 112A, that the exemption has been increased to 1,25,000 now. So if you make an LTCG taxable under 112A of 2 lakh rupees, you will pay tax only on 75,000 rupees. Only on 75,000 rupees. The rate of tax would depend. 10% if transfer takes place before 23rd July 24, 12.5% if it is on or after 23rd July 24. No other special conditions within this also, of who is acquired it, when, what type of asset, nothing else. Very simple change in rate of tax, that is all. Condition: STT paid on acquisition and transfer for listed equity shares, on transfer for units of EOF and units of business trust. Total exemption will not exceed 1.25 lakhs. So the SSC cannot say on the transfer before 23rd July 1.25 lakhs, on the transfer on or after 23rd July further 1.25 lakhs. No such provisions are there. The total exemption in a previous year is 1.25 lakhs, whether the entire transfer is before 23rd July, entire transfer is on or after 23rd July, or transfer is spread across throughout the year. No other provision. 1.25 lakhs will be the total exemption for the SSC. That is all. Condition does not apply for recognized stock exchange and IFSC. Same point. And no benefit of indexation or foreign currency fluctuation. This was anyway not there under 112A. So this is not available. That is all. These are your amendments in capital gains. One other point is section 50AA. 50AA basically tells you that capital gains from transfer of certain capital assets will always be considered short-term capital gains. Doesn't matter how long you held that particular asset for, that particular capital asset. So these three items. Units of specified mutual fund. See, specified mutual fund means a mutual fund whose total amount, right, the fund proceeds which are there, the invested amount of that particular fund, the assets under management, the fund under management, a maximum of 35% of its amount is invested in equity shares. Okay, that is the specified mutual fund they are talking about here. The balance would be in debt securities, corporate bonds, government bonds, various other items. Could be T-bills, could be any such various other items. But a maximum of 35% would be in equity shares. Maximum, okay, not minimum. See, equity-oriented fund, you would have studied minimum 90%, etc., etc. This is saying maximum 35% equity shares. Okay, that is a specified mutual fund. Market-linked debenture. Second item. Third item, unlisted bonds, unlisted debenture, transferred, redeemed, or matured. All scenarios, whether you sell them, they get redeemed or they mature, no matter what. On or after 23rd July 24. So, transfer of the capital gains arising on transfer of these items will always be considered to be a short-term capital gain only. No other capital gain. These will never give you a long-term capital gain. Okay, so these are all of your amendments related to capital gains and other items. Very, very important is capital gains and the amendments discussed for PGBP and for salaries. These three, if you ask me, sir, what is important? Entire amendments are very, very important. Within all of the amendments, if you ask me, these three are going to be the most important ones. Please study it very, very carefully. Probably you can go through the video once more before your exams or while you revise these concepts and study these amendments very nicely. Okay, this part of your preparation should be one of the focus areas for you. Not to say you have to ignore anything else, but whatever comes as an amendment becomes extra important. Okay, so we'll see examples of these things when we discuss it later on. For now, these are all of your amendments. Study well, do well, best of luck for your exams, and all the best to all of you. Thank you.